you sick and tired of losing money in the stock market? Do you want to learn how to make money quickly? Well, stick around and I'll tell you my top 10 stocks for making me $5 million in the next... Just kidding, it's not going to be that type of video. If you're new here, my name is Kim and I'm a software engineer and real estate investor. This is part 3 of my How to Invest series. If you haven't watched part 1 and part 2 yet, then I highly recommend it. Part 1 is about how to budget and get your money right for investing. Part 2 is about how to choose an investment account. And this is part 3, how to actually invest. Please remember, I am not a financial advisor, so all information in this video is not to be taken as investment advice. It is for general information purposes only. Okay, with the disclaimer out of the way, let's get started. Let's start with the basics. What is investing anyway? Investing is when you buy an asset that produces capital. In other words, buying things that make you money. So you're investing when you buy a designer bag and it goes up in value, or when you buy a book and you learn a skill that makes you money, or even if you buy an old Yu-Gi-Oh game that has 3 cards in it that has a value of 10K, possibly. Shout out to you, financialism. But the most common way to invest is through the stock market. What is a stock anyway? Great question. A stock is basically a piece of ownership in a company. People buy stocks for 2 reasons. 1, they think the value of the stock will increase in the future so they can sell it for a profit. And 2, because some stocks pay dividends, which allows you to buy more stock, or you can just take it as passive income. I think this is the part where a lot of people get stuck. They never start investing because they don't know how to choose a perfect stock, or they worry about losing all of their money, or, this is my biggest pet peeve, they're waiting for the market to crash. But the truth is, all stocks fluctuate in value and nobody can tell the future, but on average, the market tends to go upwards in value. You don't actually lose or make money until you sell your stocks. One of Warren Buffett's most famous sayings is,
"If you're not willing to hold on to a stock for 10 years, don't even think about holding it for 10 minutes.
Which brings me to what he said last year.
I don't think most people are in a position to pick single stocks.
So if people aren't in a position to pick single stocks, then what should they do? There are a few ways. Let's talk about them. The first way is through index funds, or passively managed mutual funds. Let's break that down. Mutual fund means a bunch of people pool their money together, and passively managed means that there is no dedicated manager actively picking and choosing stocks to put in the portfolio. Instead, the portfolio is modeled after a market index. An example of a market index is the S&P 500, which represents the top 500 companies in the United States. Another index is the total US stock market, which represents all of the stocks traded in the United States. When you invest in an index fund, you're effectively investing in all of the companies represented in the index. An index fund is great because it's low cost, diversified, and relatively safe because you're not putting all of your eggs in one basket. I love them because I don't have to actively pick and choose stocks myself. Let's take a practical example. One of the most common index funds people talk about is VT-SAX, which is a ticker symbol for Vanguard Total Stock Market Index Fund Admiral Shares. Whew. It is an index fund modeled after all of the stocks in the US, and it has a minimum investment of $3,000. The expense ratio is 0.04%, which means for every $10,000 invested in this fund, you pay $4. However, Vanguard is not the only firm that has a total stock market index fund. Fidelity has its own with ticker symbol FSKAX, with no minimums and an expense ratio of 0.015%, which is even lower. So what's the difference in performance? Not much. The performance is quite similar because they are modeled after the same index, which is all of the stocks in the United States. Let's compare the S&P 500 index funds between Vanguard and Fidelity. Just Google Vanguard S&P 500 and Fidelity S&P 500 index fund. As you can see on the Vanguard page, there is an expense ratio of 0.04% with a minimum investment of $3,000. On the Fidelity side, there's no minimum investment and the expense ratio is 0.015%. The price of one share for Vanguard is $355.49, and for Fidelity, it's $133.52. So what's the difference between these two? Let's look at the holdings. They're pretty similar, but the difference between these index funds is how each manager chooses to weigh each holding. The second way is through actively managed mutual funds. Actively managed mutual funds have portfolio managers who pick and choose stocks and rebalances the portfolio based on their research. The pro is that you may have higher returns than investing in an index fund, but the big con is the expense ratio. Let's take a look at some examples of actively managed funds. When searching for index funds, let's go back to our friend Google and look up Fidelity Active Mutual Funds. Here we're taken to the Fidelity site. Scroll down to see all actively managed funds. As you can see from these funds, the performance is quite high in comparison to index funds, but the expense ratios are a lot higher as well. 0.79% means it costs $79 per $10,000 invested. When looking at performance, it is also important to look at long-term performance, like 10 years instead of just 1 year. Some of these funds do perform a lot better than index funds in the long run, but others are too similar to justify the much higher expense ratios. There are even some who don't even beat the S&P 500, so do your research before going with actively managed funds. The third way to invest is by buying ETFs, which stands for Exchange Traded Funds. Let's rewind back to that Vanguard page. What if we didn't have $3,000 lying around? Well, we can buy the ETF version for the price of one share. I like to think of ETFs as basically being like mutual funds, but traded like individual stock. With mutual funds, you specify the dollar amount of how much you want to invest, and the number of shares you get is determined by end of the market day. With an ETF, prices are fluctuating throughout the day, so you have to specify how many shares you want to buy or sell. You can set up recurring investments for mutual funds, but you can't do the same for ETFs because the prices are fluctuating throughout the day. Keep that in mind if you want to be a more hands-off investor. Now that we've talked about investing in individual stocks, index funds, actively managed funds, and ETFs, let's talk about where to actually buy. I talked a lot about Vanguard and Fidelity in this video, but which is better? Both offer an assortment of low-cost index funds and no commission trading. Vanguard is pretty popular because the founder, John Bogle, actually invented the first index fund and popularized low-cost investing. But as you can see in our examples, Vanguard has minimums for their mutual funds, and they don't allow you to buy partial shares of ETFs and individual stocks. I actually prefer Fidelity for beginner investors because there are no minimums and they allow you to buy partial shares of ETFs and individual stocks. A beginner investor may be a bit more nervous about dropping $3,000 on their first investment or even $200 on a share of VTI. But with Fidelity, you can have a partial share of Tesla for only $5. So after you finish watching this video, there should be no more excuses about not investing. I want you to go to either Vanguard or Fidelity and open up an investment account. If you don't know what investment account to open, then watch my previous videos on how to choose. You can also open one at Robinhood and Webull, and whoa, would you look at that? I have some referral codes in the description box below for some free stocks. Once you open your account, contribute money to it. When you contribute money to an investment account, that money is not yet invested. It's actually held in some sort of money market account, so it's basically like a savings account and still cash. Contributing is not the same as investing. Once the money settles, buy an index fund or an ETF to start out with. As you get more comfortable with investing, then you can start to experiment with buying individual stocks. Right now, my portfolio is 99.99999% index funds, but I am trying to practice buying individual stocks just for fun. Finally,
Keep investing.
do it regularly, do it on a schedule. Don't wait for the market to drop because you're not a sidekick and time in the market is more important than timing the market. Enroll in DRIP, which stands for Dividend Reinvestment Plan, so that the dividends that you get will be used to buy even more stock. This is how compound interest will be working its magic. Follow these steps and you will definitely be in a better financial position. All right, thank you all for joining me today. If you found this video helpful, please like and subscribe to my channel. It really helps me out. I'm sorry I didn't post a video last week. I was sick and recovering, but now I'm back, so get ready for more videos next week. See y'all later. Happy investing.